So hello friends, welcome back to part 6 of the fundamental analysis concepts. Today we will be seeing the BFSI. What is BFSI? It is nothing but banking, financial services and insurance companies. This includes all in BFSI sector. Now first is the CASA ratio. What is CASA ratio? It is current account to saving account ratio. This is a better way of banks to raise money because once they show this current account to saving account ratio to any institute, they get some money at a much cheaper way compared to raising from the FDs or CDs, term deposit or certificate of deposits. So this is higher the better because it's get higher profit margin. How? Because current account pays no interest. Okay, whatever 1 crore, 2 crore you keep it, there is no interest you get from this current account. However, in saving account, bank have to pay you 4%, maybe 6% for banks like Yes Bank or something. So in this way, the higher the number of current accounts and the amount inside that, the banks gain much higher because they use this money for giving loans which earn them 12% or more. Okay, so this CASA ratio is a important measure. Based on that, the company have a higher profit margins. Okay. Now next is the CAR. What is CAR? Is capital adequacy ratio. This is nothing but the capital company's capital, available capital to risk weighted credit exposure. Okay. So the formula goes as tier 1 plus tier 2 capital divided by risk weighted assets. Now how do you assess that the assets are risk weighted? Any loan. Now firstly just know that for banks, loans are assets because they generate profit for them, and the FDs or deposits are a liability. Okay, for normal companies, non-BFSI companies, the loans are liabilities, but for banks, the loans are assets. They generate cash for the banks. So if the money is lent to government, government will definitely pay. So there is a 0% risk. But it is given to individual, it is 100% risk. Why? Individual may default in payment because of his or her economic condition. They may run away, or they may never pay. Okay, so this is 100%. Maybe MSME may get at around 40% risk. So this is how they divide all the loans given to individuals, to MSME companies, other companies like Reliance having less risk, government 0% risk, and they divide it by the this risk weighted assets. So tier 1 are basically this ratio protect the depositors. This is good for the depositors. They have to see the CAR, capital adequacy ratio, before putting deposits in the bank. So tier 1 is the capital which absorbs losses without any ceasing of the operations, whereas tier 2 is the capital which absorb losses in the event of winding up. So this is very dangerous. So this CAR should be higher the better. It should be greater than at least 12. Just remember this. Okay. The next is the net interest margin. So what is the net interest margin? First is the investment returns. This is the investment for the banks, loans, and interest expense, whatever they pay us back in FD's interest. So if the investment returns minus interest expense average is taken, it is called net interest margin. So net interest margin generated from credit products like loan and mortgages, money collected from FD and CDs and given as loans at higher rates. As I told you, we get loan at around 12%, but FD we get around 6%. So whatever is difference is a profit for bank. Okay. So NIM is a measure of profitability for the banks. Higher loans than FDs, then NIM is high. Generally, NIM is should be near to 4 to 5%. Okay. If it is low, that means the profitability is low, and if it is very high, that means there is an issue of it will reduce the ROA. We will see it subsequently. Okay, just remember this. Now, loan to deposit ratio, LDR or ADR. So total loans divided by total deposits. This assesses the bank's liquidity condition. Too high ratio means bank is unable to pay back deposits quickly, and lower ratio means earning may get affected. Lower ratio means deposits are higher, so bank has to pay on FD interest, and these are less, so they get less of 12% and they have to give more of 6%. The gap decreases, so earnings may get affected. So ADR should be ideally near 1 or just less than 1. It is 80 to 90% is recommended, and it assesses the health of the bank, but quality of the loans can't be checked. Now you can't check the quality of these loans, that how much of them are 0% and how much of them are 100% by looking at this ratio. Okay, next is the equity multiplier. So now what is equity multiplier? This is total assets divided by shareholders equity. This is an indicator of risk, how much risk a bank is taking. So portions of companies assets financed by equity and not by debt. Okay, so if they have collected through IPO or some other FPO, they collected some equity money, and if they buy assets from this, then it is financed by equity, and if they buy through debt, then it is through debt. So higher EM means more assets are created by debt. If it is higher, that means this is high, this is low, and if this is low, that means debt is used to create these assets. Now EM should be ideally less than or equal to 15. Okay. Now there is one important rule of 15. You must remember, there is a formula of ROE is equal to EM into ROA. So what is the formula of EM? Total assets by shareholders equity. What is the formula for ROA? It is PAT or net income divided by total assets. So if in this multiplication, if I cancel this out, this becomes PAT divided by equity. This is nothing but returns on equity. Okay, net income divided by equity, it is ROE. So this should be minimum 15%, this should be maximum 15%, and this should be minimum 1%. So just remember this rule of 15. Now there is one more term you must be hearing it, non-performing assets or NPAs. The NPAs of the bank is has risen compared to last quarter or last year. So ideally this should be zero, but it is never zero. But it should be less than 1%. It is considered as good. This indicates the credit risk. Now what is NPA? These are basically bad loans. If somebody has taken loan and not paid it, and he will not likely to pay also, like Vijay Malia or Nirav Modi who has run away. So these are considered as bad loans. So company consider it as a total loss. So there are two terms in this. One is the gross NPA and net NPA. And net NPA formula is gross NPA minus provisions. So what does bank do? Bank earn net profit. Okay. So out of this net profit, they keep some cash, like a free cash flow, and some profit they use it to cover up this bad loans and take it out from the book of accounts. So this is called provisions. So portion of bank's profit set aside to cover some losses incurred by the NPS, and this is shown in the balance sheet liability liability row. Okay, so this is called non-performing assets. Now there are certain important concept I would like to highlight to you is coffee can investing. There is a gentleman called Saurabh Mukhreja. I don't know, Mukherjee or Mukhreja. He has written a book called Coffee Can Investing. So in olden times in US, the houses were made of wooden in a far-flung places. So when they used to go to the farm, anybody can come and steal their money. So they used to put this money inside the coffee can and bury it inside the ground. Okay. So this is how they can protect the money, and they used to take it out only in case of requirement, in terms of emergency. So this is how the concept of coffee can investing, and then the concept says that you invest in a company having two major parameters for invest and then forget it for next 10 years. So for non-BFSI stocks, the parameters are sales growth should be greater than or equal to 10% every year for past 10 years, and ROCE should be greater than 15% every year for past 10 years. Okay. For non-BFSI stocks, it is a loan growth should be greater than or equal to 10% every year for past 10 years, and ROE should be greater than or equal to 15% every year for past 10 years. So this is every year, it should be 10% or 15%, not average of 10 years. Just remember this. So there is some company, say 2016, 2017, 2018, 2019, 2020. Likewise, if you see the Skinner website, it is shown like this. So if it is 100 crore sales, then next year it should be 110. Next year it will be 121 minimum. This is minimum I'm talking about. Okay, something like this. So this should be 10% increase. This should be 10% increase year on year. This should be increased 10%, and this should be increased 10%. Okay, and not like 100 this year, then anything this year. Okay, and lastly 144. So average rise is 10%, nothing like this. It should be this example. Okay, for all the parameters. Now this concept I read in during COVID times 2020. So I made one portfolio, CCI 2020. Now it is said that if the company performing last 10 years in this manner will perform further 10 years in the same manner. So what is happening that if you make the list of such companies every year, there is a repetition of all the stocks, maximum of the stocks. So there is no point creating the such portfolios every year. So I made one portfolio of selected stocks of CCI 2020. I again made it in 2023, 3 years gap. Again I will make it in 2026, 3 years gap. Again I will make it in 2029. Okay, so now what happens, this will finish 10 years in 2030, 31. So after 10 years, if I sell it, some profit I'll keep it, and some profit I will invest in this next 3 years wala CCI. Then 2035 CCI will be fed by selling in between this. Then 2038 CCI will be fed by selling it in 2036. So likewise, this becomes a laddering effect. So this is one effective way of creating wealth over a long time. So if you use this concept, is a very good concept. This concept and all other concepts taught earlier in part all the parts up to 6, we will sheet in the some Excel sheet from the screener.in website. So that's it for today. If you like this video, please share it with your near and dear ones. And that's it for today. Thank you very much. Great day. Have a great day.